Hi everyone, welcome back to chapter 9. We continue to discuss the inventory measurement by explaining how the inventory is measured at end of each period. And in addition, we wanted to investigate the inventory estimation techniques and method of simplifying LIFO and changing how to change inventory method, and if there is any inventory error, how we treat it. Okay, so first of all, we wanted to talk about the subsequent measurement of inventory. And the circumstances arise after purchase and the production of inventory that indicates that a company will sell inventory for less than its cost. Hence, that we wanted to figure out in that case what we will do. First of all, the possible reason that purchase the inventory will have a less than the purchase cost, it might be mainly due to such as inventory damage or physical deterioration or obsolescence or changes in the pricing levels. And then all these reasons are gonna result in a reduced ability to sell those inventory. Hence, the gap that requires companies to evaluate their unsold inventory at the end of each period. And if we find that the expected benefit of unsold inventory is estimated to fallen below the cost, the company must take in an adjusting entry known as the inventory write-down to reduce the inventory and also decrease the net income for that period. And the approach that the company can choose, there's a two approach. One is called the lower cost of net realizable value, and one is called the lower cost of market. And then these two methods implication in the financial statement is very similar. Both are reduce of the reported inventory and also both reduce the net income. The only difference is that first of all, the company that are eligible for LCNRV are the company using FIFO average cost or any other methods except the company using LIFO and retail inventory. And the company eligible for LCM method is only the company apply LIFO method or retail inventory method. So first of all, I will introduce you about what is the LCNRV method, which is lower of the cost or net realizable value. So what is the net realizable value? Net realizable value is estimated selling cost minus the handling cost. The handling costs such as completion cost, disposal cost, and transportation cost. The net amount a company expected to realize from the sale of the inventory. So LCNRV at the end of the year, a company wanted to compare the cost of the ending inventory to the inventory's NRV to decide whether needed to write down the inventory. If the NRV is lower than the cost, an adjusting entry is needed to reduce the inventory to the NRV level. If cost is lower than the NRV, then no adjusting entry is needed. So let's look at this example. The clothing company has 5 inventory items on hand at end of each year. The year-end costing, which they are applying FIFO method, and the net realizable value for each items here. And A item and B item are a collection of similar items, and C, D, E are also another collection which are similar. So therefore, the company, what they do is they list the cost of purchase prices for A, B, C, D, E, and then they also estimated an NRV for A, B, C, D, E. And then they individually compare which one is lower, such as for A, cost is lower, hence that the lower cost of NRV system pick the cost. And for B, NRV is lower, hence the cost lower of cost NRV is picking the NRV up. So on and so forth. And then 5 items lower of cost NRV add up together is $395,000. And by category, you can also do that as well. You don't need to have to compare individual items. If you feel like each A and B and C, D, E are similar, you can group them together as a category to measure which one is cost lower, which cost is NRV lower. So such as total A and B is 150 at cost and NRV is 175. So since that A and B adds up together, the cost is still lower, hence you can pick by category. Comparably, CDE group that the NRV is 256 and cost is 265, so therefore they pick NRV for that group. And the resulting cost of lower of cost and NRV is 406,000. And then you can also compare in the total inventory as well. Okay, so now let's look at how do we adjusting the cost to the net realizable value. And then let's say that we wanted to using the individual items as example, so which is a 395,000. So the cost of $415,000 either recorded at the inventory was purchased needs to adjust to 395,000. And then the journal entry will be debit cost of goods sold and crediting inventory of $20,000. And on the GAAP, the thing is that if the reversal are not permitted if you are on the GAAP. However, the IFRS consider that in circumstances that the net realizable value is recoverable, hence that you can reverse the adjustment. And then the second method of valuing is for the people who use LIFO and retail inventory method. And if you use LIFO and the retail inventory method, you need to use lower cost or market method. And this cost method is basically comparing the purchase price with the market price. The market price here we are defined as inventory current replacement cost. However, this market cost has to be between a ceiling value, cost value, and the floor costing value. The ceiling costing value is net realizable value that we just introduced, and the floor is the net realizable value minus the normal profit margin. So let's look at an example here. First of all, in order to use LCM system, you first need to figure out the ceiling itself and the floor itself. Okay, so for a selling price of 100,000 item A, the estimated handling cost is 15,000. So therefore, the NRV for this product is 85,000. And the normal profit margin is 20% of the selling price, hence 100,000 multiple 20% is $20,000. Hence that the floor is gonna be equals to 65,000, which is use 85,000 minus 20,000. So B item exactly same thing. 120 minus 30 is 90,000 NRV, and minus normal profit margin, which is 120 multiple 20% is $24,000, and then NRV minus normal profit margin is 66,000. That's the floor. Hence that if you wanted to compare in the cost and the market, you wanted to have a column called a cost column, which is the purchase price, and then you wanted to evaluating the current replacement cost of each item, which is if you go buy the product now, how much you can buy it for. And then after you just last step, you're calculating the ceiling and the floor. So first, and then you can using this 3 column, which is 2, 3, 4 to generating number 5. The rule is that if replacement cost is between NRV and the floor, then you use replacement cost as market value. If the replacement cost is lower than the floor, then you will choose the floor as the market value. If the replacement cost is higher than the ceiling, then you will only use the ceiling as a market cost. For example, item A has a replacement cost for 55,000, which is lower than the floor of 65,000. Hence, we pick the floor as market value. And then item B has a 97,000, which is much higher than the ceiling. So therefore, we want to use the ceiling as market value. And number C is a 70,000 replacement is between ceiling and floor. Hence, we use the replacement cost at market. After you pick the correct market value, then you will compare the cost with market to figure out what is the lower cost of market. So for example, number A, the cost is 50,000, the market 65,000, hence we pick the cost. On number B, 100,000 is the cost and the market value is only 90,000, hence we use 90,000. So on and so forth, we figure out that the lower cost of market method generating $387,000 of ending inventory. Hence that we wanted to record this adjusting down or write down the inventory from $415,000 to $387,000 by journal exactly like what we did last time: debit cost of goods sold and credit inventory. Of course, you don't have to do individual by individual items on the LCM method. You can also compare by category or compare by inventory as a whole. Okay, so we wanted to, besides talk about the subsequent valuation of inventory, I wanted to introduce how do you estimating inventory. And the reason that we need to use the estimation of inventory is because there a lot of companies actually in situation it's become very difficult or impossible to physical count the inventory in the end period. For example, larger retailers company location all over the world sell many more items, and then it's hard to tracking the cost of each item, and also it's very hard to complete the physical count in the end of the period. Hence, we wanted to use a gross profit method, or known as gross margin method, to estimating the inventory cost and the ending inventory. And this kind of method is ideal in following situation. First of all, when you wanted to determine the cost of inventory that has been lost or destroyed or stolen, this method is very helpful. Second, in estimating inventory and cost of goods sold for interim period, avoiding expense of physical counts, that method is helpful too. Also, the auditors testing the overall reasonableness of inventory amounts is also useful using this method. And last one is used in the budgeting and the forecasting period. And then comparing to the usual inventory, ending inventory and cost of goods sold method, usually we use a goods available for sale as a pool and split between ending and cost of goods sold. We wanted to use a physical count and figure out the ending inventory and plug in the cost of goods sold. But this gross profit method is the opposite. We first wanted to figure out what is the cost of goods sold by using a gross profit margin, multiple sales, and then we figure out the ending inventory. Of course, under this method, everything is only estimated, it's not the actual cost. Okay, so for example, this company had a beginning inventory at 600,000 and the purchase 1.5 million, and the goods available for sale is 2.1 million. And then they know that the sales in total is 2 million and then gross profit is 40%. Hence that sales minus the gross profit, you can get the cost of goods sold, which is 1.2 million, and then its ending inventory is only 900 million. And then, but in order to use this, I just want to give a word of caution. First of all, this method's accuracy is totally depending on the gross profit ratio's accuracy, right? And we know that we needed to try our best to obtain the best estimate of this gross profit ratio. And also the accuracy of the estimate can be also improved by grouping some inventory together as pool of products that have a similar structure and profit relationship. And then also companies' cost flow assumptions also should be implicitly considered when estimating the gross profit ratio, such as LIFO method, because we always sell the last in inventory. Hence, the prior inventory's profit ratio might not be really applicable. And the fourth is the suspect the theft and the spoilage is hard to be estimated using this gross profit ratio method. Okay, so we mentioned that the LCM can be applied to LIFO and the retail inventory method. And what is a retail inventory method? Retail inventory method is still an estimation of inventory cost, okay? And it's used under high volume retailers selling many different items at a low unit cost, such as Sears Holdings, Walmart, Target, JCPenney, and Macy's. So what we do is first we want estimating amount of ending inventory at this retail price. And then the amount of ending inventory at a retail price must be equal to goods available for sale at retail price minus sales at a retail price. And then ending inventory is multiplied by a cost to a retail price ratio to estimating ending inventory at its cost. And the cost to retail percentage is equals to goods available sell at cost dividing goods available sell at a retail price. Okay, so here you go. First of all, beginning inventory costs 60,000, retails 100,000, net purchase 100 to 87,200, and retails 490. So the good available for sale, the cost is 347,000 and the retails 560. So the cost to retail price is actually 62%. And then since we know the net sale is 400,000, hence that the ending inventory at the retail price is going to be 160. So to translating the retail price back to the cost, we just multiply the cost to retail percentage, and then we can find out the cost itself at the ending inventory is 99,200. Hence, estimated cost of goods sold is 248,000. And the retail inventory method, we also need to make sure that we consider the initial markups, which is the original amount of markup from cost to selling price, and the additional markup such as the further increasing in the selling price subsequent to initial markup. Also, sometimes people can cancel their markups, which is the elimination of additional markup, or scenario like reduction in the selling price below the original selling price, or markup cancellation. For example, if the original cost is $6, you can give it the initial markup to 4, and then the original selling price become 10, and then you can give additional markup of $2 and then push the selling price to $12. Then you can say I want to cancel a markup for $1.5 and then reduce the selling price to $10.50. Or original cost is 6 and the initial markup is 4 and then selling price is 10, but there's a markdown of $3, reduce the selling price to 7, and then you can cancel the markdown about $1, the selling price increase to 8. When applying the retail inventory method, the net markup and the net markdown must be included in determination of ending inventory at retail. For example, the Home Improvement Inc. using a periodic inventory system and a retail inventory method to estimating the ending inventory and the cost of goods sold. The following data are available for the month of July. So the cost of beginning inventory is 99,200 and the retail price was 160,000. And there's a net purchase at cost of 305,280 and the retail price is 470. And there is a markup for 10,000 and markdown for 8,000, and net sales is 434,000. So beginning inventory plus net purchase and plus net markup down minus markdowns is getting a retail price of 632,000, and the cost itself is actually equals the beginning plus the purchase cost. Hence, we're getting a relationship between the cost and retail here, about 64%. If we know the net sales is 434, then we know the retail price of the ending inventory is 198. So therefore, to calculating the cost of ending inventory, we just need to apply the cost to retail percentage to 198,000. We're getting a 126,720 ending inventory at cost. And in the end, we find out the cost of goods sold using all available for sale minus ending inventory. We get the cost of goods sold. And then besides using like a normal inventory method, we can also use a conventional retail inventory method. Under this method, there's one trick is that we do not consider markdowns in the ratio calculation. We only consider purchase price and purchase retail price and markups. We excluding markdowns to calculating the cost to retail percentage. However, when we consider all available for sale retail price, we do including markdowns. Hence that once we sell the 434,000, we're still getting estimated retail price of the ending inventory at 198,000. But currently we are using a more conventional cost to retail percentage, which is 63.2%. And then hence that the ending inventory is only 124,000 comparing to non-conventional of 126,000, and the cost of goods sold is a little bit higher as well, increased to 179,000. And then besides this, I also want to stress that the LIFO method on the inventory method, retail method is a little bit different. You can apply FIFO average cost using current this method, but in terms of LIFO, I want you to use this method. First of all, we talk about the LIFO method is very special and expensive method, right? And then it assumes units sold are the most recently acquired. So when there's a net increase in the inventory, we understand that LIFO result in inventory that including, first of all, the beginning inventory and the one or more additional layers during a period. If there is a net decrease in the inventory quantity, that means the LIFO layers are liquidated. That's what chapter 8 talk about. So when we in applying LIFO to retail method, we assume that the retail price of goods remains stable during the period. So therefore, we're comparing the beginning and ending inventory dollars to determine if quantity is increasing or decreased. Let's see an example. So first of all, we wanted to consider the beginning inventory cost layers and the retail relationship as a constant. And then we wanted to look at the purchase and the net mark and net done as a separate layer in July. So therefore, the relationship between the 305,280 and 472,000, this relationship are additionally layered, right? Although all of this adds up as total available for sale for 404,480 at cost and 632,000 at retail. But we know that we wanted to separately consider the inventory layer, beginning inventory layer, and the July layers. And then we're getting the relationship between the beginning inventory cost and the retail relationship is 99,200 dividing 160,000, which is 62%. And then if we consider July's purchase only, we will use the 280,000 dividing 472,000, which is 64.68%. And then if we minus the less than net sales, 434, we still get 198 at the retail price for ending inventory. However, this ending inventory we consider as 2 layers because it's big. First layer, first of all, it's bigger than the beginning layer. That means that it's consists with a beginning layer of 130,000, and it's also adding an extra 38,000. And the beginning layers, right, we consider the relationship between the cost and the retail price is a beginning relationship at 62.2%. And the extra $38,000, this relationship we consider as the additional relationship, which is going to be 64.68 between the cost of the retail prices. So therefore, the total cost is become $123,778, and the ending inventory is $280,702. Okay. So the third topics that we want to talk about is how to change in inventory method if you wanted to. First of all, there's also two categories. Most inventory changes we wanted to use a retrospective treatment, meaning that we have to revise all comparable statements, adjusting all the affected accounts, and also disclose all relevant information. But if you change into LIFO method, that's a different story. LIFO method is prospective, means that you only need to adopting the method, doesn't need to restate anything in prior period. You can start to using it at the beginning of the period that you considered to adopt the LIFO method. Okay, so I want to show you guys an example. So AutoGeek Inc., a wholesale distributor of auto parts, began business in 2018. The inventory reported in 2020 year-end balance sheet, determined to use the average cost method, was $123,000. In 2021, the company decided to change its inventory method to FIFO. If they do that, okay, the FIFO method will have an ending inventory about $146,000. What steps should AutoGeek taking to report this change? This company needed to record a journal entry. First, increase the inventory value to $146 by debiting $23,000 on the inventory account. And second, it needed to increasing the returned earning for $23,000 to adjusting the returned earning to current period, as of it had been using the FIFO since day one. And when a company decided to changing to LIFO rather than other inventory method, it's usually impossible to calculating the inventory effect from the prior period. So to do so would require assumption as to when a specific LIFO inventory layers has been created in prior years. So a company who decided to change to LIFO usually does not need to report the changing retrospectively, and the LIFO must use from that point on, and the base year inventory is the beginning inventory in the year of LIFO method is adopted. And then in the disclosure, changing in inventory disclosure, especially LIFO method, you first have to disclose the nature and justify the change reason, right? And then you also needed to show why retrospective is not applicable or impractical. And the third thing you needed to do is to describe the effect of a change if the LIFO has been used from day one. Okay, so the last segment of knowledge that I want to talk about in this chapter is inventory errors. Okay, so everybody may incur some errors, especially inventory errors is more often than usual. And the errors occurred in inventory, including overstating or understating ending inventory. And the cause of the mistake made may be because the physical count mistake or recording purchases mistakes. Such mistakes can be treated as two different kinds. First of all, if you made this error and being found in the same accounting period, that's easy. The only thing you need to do is to reverse the erroneous original entry and then make a correct journal entry to correct it, right? And then the second criteria is that when the error is discovered in the subsequent accounting period, didn't realize when did you make the error and years later you find out. And then that's trouble because you have to take in 4 steps to correct that error. First of all, you have to use the previous year's financial statement has to be retrospectively restated. It means that if the error has never made what those prior year's financial statements should look like. Second, incorrect account balances are corrected by journal entry. I'm sure that in the prior year there would be some errors carried on and on and on for multiple periods. And then to current year, which account has been affected by that error, you have to restate it and correct that balance. And third, the correction of returned earning is reported as a prior period adjustment to beginning balance in the statement of shareholders' equity. And most importantly, the inventory errors will always landing into net income and further transfer to the retained earning. So if the error has been happened years ago, then means that this current year's retained earning account is absolutely not right. Hence, you needed to make adjustment to the beginning balance of current period retained earning to correct the mistakes that has been carried. And the last thing we need to do is to disclose and describing the nature and the impact of the error. So let's look at visualize the effect of inventory cost error. If we made error in, say, ending inventory, it will impacting the cost of goods sold accuracy, right? And then if the cost of goods sold is wrong, that will carry over to the income statement, which make the net income is wrong. When the net income is wrong, it will carry over to the balance sheet, which is end up with a wrong ending return earning. In other words, an error in recording either purchases or calculating any inventory will transmit it to cost of goods sold, further give to net income mistakes, and further get into the balance sheet return earning. So let's look at an example here. So the Barton Company using a periodical system at end of the 2020, a mathematical error caused the $800,000 of overstatement of the ending inventory, and the ending inventory for 2021 and 2022 are correctly determined. Assume the error is not discovered until after 2021. So let's say by 2020 you have overstated your ending inventory, which caused you understating your cost of goods sold. Because understating cost of goods sold for 800,000, that means that you overstated your income for 800,000, which further overstated your ending return earning for 800,000, right? And then because you overstated the ending inventory of 2020, that means you are overstated your beginning inventory for 2021. Even the net purchase and ending inventory for 2021 is accurate, doesn't matter. The cost of goods sold is overstated again. And then because the cost of goods sold is overstated, hence that you carry into the income statement, that's result understated net income. And then understated net income carried into the balance sheet return earning get canceled out by the prior years as overstated, hence the return earning is a corrected number. Okay, so let's say if the 800,000 overstatement causes the following errors in 2020. So first of all, the ending inventory overstated in the balance sheet, and the net income is overstated, and the return earning is overstated in the balance sheet and income statement. If the error was discovered in 2021, and what we needed to do? First of all, we needed to make sure we debit return earning because it's overstation, right? Hence, we want to debit. And then we want to credit out the inventory because it's overstated inventory. So that's how we're correcting 2021's balance sheet, right? And the second of all, if the error is discovered in 2 years later instead of 1 year later, first of all, no correcting entry is required as the error has been self-corrected in the return earning account, right? But in the 2021's financial statement, you do need to retrospectively restate and reflect correcting cost of goods sold and the net income, because cost of goods sold is understated, right? And net income is overstated. You have to correcting the temporary account or income statement account. And also a disclosure note in the company's annual report should describe the nature and error and its impact on each year's, right? Such as net income should state that overstated 800,000 in 2020, understated 800,000 in 2021, and the line item affected and earning per share being affected. Okay, so that's it. This is what the chapter is about. Just to recap, first of all, we introduced how to measure unsold inventory. And we introduced that on the LIFO method, we want to use LCM, lower cost of market. On the FIFO and the average method, we want to use the L cost and NRV method, right? And we say market is actually between the NRV and NRV minus the profit margin, right? Okay. The second topic we introduce is how to estimate the balances of ending inventory. And we talk about the gross method, gross profit method, right? And then we talk about what is the retail method to estimating the cost of goods sold and ending inventory. We talk about the cost to retail ratio, right? Okay. So, and then we go on to how to, if you wanted to change the inventory method, and what do we do? And we say that on the FIFO method or any other method, we want to use a retrospective. And then on the LIFO method, we on prospectively, which means just going to the future. And then the last episode we talk about it is actually how do we correct inventory errors, right? And we said there is an error made in current period and error made in the future in a later period, error be found in the future period. And then both are having different treatment, okay? And all those things are miscellaneous items that we discuss. And I believe based on the chapter 8 study and chapter 9 study, our inventory understanding has been improved a lot. And the most important thing is that LIFO method always have a complication associated with it, because look at the measure the unsold inventory, LIFO is pretty much different. And under the retail method, we want also have a treatment of LIFO retail is totally different as well, right? We use a different ratio. And then when we say changing inventory method, the LIFO is also different. LIFO can only conduct it prospectively. And when we are correcting inventory errors, and we say that the errors found in the future period is much complicated to deal with. And this is not a very difficult chapter, but I believe every 5 of these knowledge points is new to us. Hence that there will be a lot of exercise and there will be some lectures accompanying those exercise. And I will see you guys in the classroom. Thank you.